pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
If I can get an attendance, starting with David. David's here.
Here.
Neil.
Here.
Jason. Mike.
Here.
Michael.
Yep.
And I'm here.
Okay.
Any public comment? Seeing none, we'll move on to approve the minutes. Can I get a motion for the minutes for February 5th, 2025? Second? All in favor?
Aye.
Aye. Any opposed? Not hearing any, they're approved. I'll turn it over to Brian for quarterly portfolio review.
So I will take you into page 1, right, overall market commentary. What we really faced in the first quarter of 2025 was a reminder to investors of why we have a diversified portfolio. And I can put that out as simple as, in the first quarter of 2025, the S&P was down 4 and change. Small cap stocks in the US were down 9.5. Large cap growth stocks were down 10. Large cap value stocks were up 2. So just from a growth versus value standpoint and being diversified, you had one part of the U.S. equity market or a component of the U.S. equity market that was slightly into positive territory, and technology names down 10%. But further out from a diversification standpoint, right, investors have been frustrated the last few years of owning international equity instead of having more U.S. Well, developed international stocks in the first quarter were up 6.8%. So 10%, 11% difference in performance between the S&P 500 and developed international equities. Emerging market equities were up just shy of 3% for the quarter, and high quality U.S. fixed income was up 2.8%. Depending on you were from a duration standpoint, that number is between 2.5 and 3. So, to the question of why do we own something other than the S&P 500, which has been a difficult question to stand in front of investors and answer for the last 2 years. The answer is because of instances like the first quarter, where when we have a degree of uncertainty around tariffs and how that's going to impact trade and the economy, and you have market volatility creep back in, this is why we have a diversified portfolio. Now, that being said, I always love this, markets are down in March and in April. Okay, the S&P's down 4% in the first quarter. In the last year, it's still up 8%. So you put $100 in the S&P 500 a year ago, you have $108.25. Yes, you had 112 or 113 on Jan 1, but you still have 108. Like, you have more than you did a year ago, but less than you did 3 months ago. Or, hey, I'm down 4%. Like I'm losing money. Okay, in the last 5 years, the S&P's annualized 18.5%. So $100 you put in there 5 years ago is worth $200 today. Yes, it was worth $210 or $215, but it's one of those, I'm sorry you have $100 more than you did 5 years ago, but you have $15 less than you did 3 months ago. So I always love the comment, when there's near-term volatility, zoom out. And taking that opportunity to zoom out, you realize, okay, I have less money than I did a couple of months ago, but I have a heck of a lot more money than I did in my portfolio a year ago, 3 years ago, 5 years ago. To that end, I always think this is an important measure, right? Zoomed in too fast on myself. Page 3, the mountain chart. 11 years ago, the township made the decision, right? Went through an extensive financial due diligence process and made the decision to issue bonds to fund the pension plan. Well, 11 years ago, that was $84 million in market value. We've had $34 million, just over $34 million transferred out of the portfolio to the GDA. So that portfolio, market gains, market losses, but over that 11 years, market gains has added just over 8.07%, or in dollar terms, $62.7 million. So to the question of, was it the right decision? And I know I've said, I'm going to sound like a broken record. You can go back and copy and paste from the prior minutes. It has been and continues to be a wise financial decision for the township to undertake that endeavor. To me, if you have one chart to look at in the portfolio, one page to look at in the book for the DB, this is it. Was it the right decision? Yes. So let's take a look at individual results. Take you to page 4 in the book. As I'd mentioned, U.S. equity markets in negative territory. Overall portfolio down 1.1%. Policy index, or essentially a passive representation or an index fund representation of the portfolio, was down 1.96, so a little bit of outperformance. I always feel like it's an empty victory lap to come in here and say, hey, give us a pat on the back for losing less money than we could have. But as long-term investors, we know that sometimes markets are going to be in negative territory, so it's always encouraging when we see defensive managers hold in. The one negative spot in the portfolio from a relative performance standpoint, meaning performance versus benchmark, was Ancora. And what's interesting is if you're disappointed, the reason for their underperformance in the first quarter, down 2.2 versus benchmark up 2.1, is the reason why their 5-year number is ahead of their benchmark and their since inception number is ahead of the benchmark. And that's names like Broadcom, Apple, and Microsoft. Broadcom has been David Sowerby always refers to it as the poor man's NVIDIA. So it's been a large position in their portfolio, and they've rotated in and out of it based on strength and weakness. Of the 4.3% in underperformance, Broadcom was responsible for 2.4 of that. So roughly 60% of the underperformance in the first quarter was because of one name. And that one name has been one of the biggest drivers of their long-term success. So from our standpoint, you get a pass for that. The other thing that's encouraging, those names have recovered here in April, and particularly, maybe not through yesterday, but like yesterday, absent yesterday, there's the best 9-day run in the S&P 500 since 2004. So you've seen some recovery in a lot of those Magnificent Seven names and whatnot. Fidelity S&P 500 index, no surprise. Clarkston outperformed. They came into the quarter with 11% in cash. They exited the quarter with 11% in cash. That was the primary driver of their outperformance, right? Cash in a negative market environment is going to be a positive contributor to returns. They've put half of that cash to work, so they're now down to about 5%. 5 of the 6% they put to work went into the existing names. For us, that's a vote of confidence of we believe in the names that we own because we're adding to them as they've traded off. They added one new name in April called MedPace, which is a Cincinnati, Ohio-based clinical testing, like clinical trial company. So they added that as a 1% position, and that's typically been Clarkson's way of starting to build up, right? We're going to add a name we like at 1% and monitor and add based on continued conviction in the name. Reinhardt outperformed. They were a new addition back in January of last year. Recall just diversifying exposure away from just Clarkson and the index fund, because while we've talked about diversification from a stock, bond, cash, real estate, private equity, and U.S. versus international, we also want diversification from style and investment approach within more volatile parts of the portfolio like U.S. small cap names. So Reinhardt, great job. Decent job in the quarter protecting capital. Great job since they've been added to the portfolio. Continues from our standpoint to be a high conviction name. Fidelity Extended Market Index Fund is generally considered a proxy for the small and mid cap part of the market, but it is the U.S. equity market minus the S&P 500. So between those two index funds, we own the entire U.S. equity market. You see down 8 and change for the quarter. One change we had during the quarter, as we'd mentioned at the February FSC meeting, is we were going to be rotating out of Edgewood. So Edgewood was eliminated during the quarter, and those assets were moved into the S&P 500. That is part of what helped the overall total fund outperform the policy index by 0.8, 0.9%, because large cap growth stocks were down 11 or 12% versus the S&P down 4. So that shift, it was right before we saw, and this wasn't a market timing, it was we've lost conviction, it's time to move on. After that trade was made, that's when we actually saw large cap growth stocks start to trade off pretty significantly. So better to be lucky than good from a timing standpoint, but it was definitely a benefit to the portfolio. Biggest driver of performance was the Fidelity International Index Fund, up 7.9, almost 8% versus its benchmark up 7. Why index funds so different than what we saw, for example, from the S&P 500? And it's because from an international equity standpoint, it is not a full replication. So it's not owning every single stock. It's owning as close as we can possibly get to the index we're trying to represent, because given the number of dollars in the Fidelity International Index Fund or the Vanguard International or BlackRock, there are companies they can't own because they would have a controlling interest. There just aren't enough shares available. So they get as close as they possibly can. And over time, it will be similar to the experience. New addition to the portfolio was just added at the end of the quarter was the ABS Emerging Markets portfolio. Another strategy for us is a very, very high conviction name that replaced the JP Morgan portfolio. Where this ABS portfolio is a little different is rather than it being a portfolio, for example, JP Morgan was 50 to 60 names managed by a team based in New York City with analysts around the world. This ABS portfolio is comprised of 21 or 22 underlying managers. So ABS is not picking stocks. ABS has a global presence, and they find the best in-country investment managers. So much the same for us as a U.S.-based, investment consulting firm. We, as U.S. investors, we understand, the culture and everything that makes the U.S. unique versus other countries around the world, and investing here, that's where we have Reinhardt and Clarkston and Ancora. So we've found the best in-country investment specialists for U.S. equity markets. ABS uses that expertise. So if we're investing in Brazil, it is not a U.S.-based team investing in the Brazilian equity market. It is an investment manager based in Sao Paulo that through their research of Brazilian equity managers, this is the number one in the space. Or if we're investing in South Korea or Taiwan or South Africa, it is in-country specialists. So what we end up with is a lot of exposure to small and mid-cap emerging market names, not Tencent, Alibaba, Taiwan Semiconductor, Samsung, the top 10 names. We're going to see that in more actively managed portfolios. So we think that's a unique piece. They've come out and published a few pieces around tariffs, and they're like, look, in talking to our underlying managers from a tariff standpoint, they're like, have at it. Because our trade is all domestic. We're producing things for our own residents to purchase. We're not reliant upon international trade. As long as our middle class keeps growing, we can sell more products within our country. So it's funny to think of domestic production not from a U.S. standpoint, but it's like, no, this Brazilian equity manager is like, look, our economy's growing, or India is booming. So from an Indian, equity market standpoint, they're like, we're focused on Indian consumers, not cross-border trade. So very unique perspective. From a real estate standpoint, there's a lot of zeros here. Just from a timing standpoint, things haven't reported yet. The one that I would expect shortly would be principal. That's going to be probably up in the 1 to 1.5% range. So this would be the third straight quarter where we've seen positive returns out of commercial real estate. So seem to be turning the corner in terms of the market processing and understand, unlike prior years, the comment was always survive until 25 because the Fed's going to cut rates. Now, developers and investment managers in that space have come to the realization, okay, higher for longer is actually what it's going to be. A 10-year treasury at 4%, while we think that's high, is still below the long-term average, over the history of the treasury markets. We've got to figure out how to operate in this environment. And what you're seeing is, the income number has always been there from a positive standpoint. Now you're starting to see the appreciation or prices actually be positive. Positive meaning just north of zero, not something to necessarily get excited about, but the bleeding seems to have ceased. Final piece, capital dynamics. Some of you heard this, I mentioned it, tail end of RHC, but just for the benefit of the minutes. We don't yet have 1231 pricing just because of the underlying nature of how that portfolio is built. However, initial forecasts that I got actually last week, I just pulled it up between meetings, have that portfolio marked at a 1.3 multiple. So for every dollar put in, it's worth $1.30. So that hasn't been finalized and pushed out from a statement standpoint. So the negative 5% return that you see there is the impact of us paying investment management fees and interest to earlier investors in the fund. We become a beneficiary of interest being paid by later investors that come into the fund. But when we get that 12/31 statement, so for example, when you look at the June 30 report for this, you should look at that number for Capital Dynamics and say, is that right? Just from the standpoint of, I expect it to be a nice positive number. So that should, help further boost returns. So all in all, the portfolio held in well in a difficult quarter from a U.S. equity standpoint, U.S. equity market standpoint. Where we saw outperformance was expected with Reinhardt and Clarkston. Where we saw underperformance, notably from Ancora, it's understandable. So from our standpoint, there's no recommended changes at this time. Continue to look and explore other opportunities. But we're pleased, particularly for the quarter, with how things held up. Questions?
So I just want to add on the on our LP holdings. So on our real estate holdings on TerraCap and Principal, we're fully funded with those private investments,
Correct.
right? So we're basically now just waiting to harvest on those investments, and we're going to see, we're starting to see Principal. We get a cash dividend or distribution every quarter.
Mm-hmm.
It's not a huge number, 20, 30,000, but we're getting some cash from them that it's throwing off. And then we're going to, put that back to work in our other investments. On Bloomfield Capital, we're fully funded on Series C and
Almost fully funded.
almost fully funded on Series D, right? So they can still come back and call, I want to say it's a couple $100,000 left to fund on that. So right now that cash is either in our cash account or in our other equities, and when we get a capital call, we'll pull that money and send it. Under the alternatives, Capital Dynamics, we're only about 40% or so funded on that.
41.
So we just I just funded a capital call, I think it'll hit today, for $90,000. So again, not a big number, but so we're slowly starting to build up on that. And again, that's cash that's invested in other parts of the portfolio that when we need it, we can take it and send it off to Capital Dynamics. But we are committed, I believe, $5 million to them.
Correct.
Right, was the number? Right, so we're still about 45% funded there. So there's still more investments to come. So I just wanted to address that.
And we'd expect Bloomfield will be making quarterly distributions probably in the 8 to 9% range. So that creates a source of cash. If we have a cash need for a capital call or we need to make a contribution to the GDA, it's a source of cash.
Annual yield is 8 or 9%.
Correct.
Okay, it's not 8 or 9% every quarter. Okay,
That would be lovely, but
I know,
Annual, yeah.
so 1 quarter of that.
And we're very good on the GDA. I just want to clarify that. We're going to be earning over 4% this year on GDA money. So I don't expect any kind of MIFL requirement anytime soon.
Real quick, did Reinhardt have any extra cash, being small cap, or were they?
No, so Reinhardt, the threshold for being fully invested is less than 5%, and Reinhardt typically keeps that at like 2 or 3.
Okay.
One of the regular sources for kind of unexpected cash for Reinhardt is takeouts. So the PMV that you see after their name is private market value. So rather than Matt Martinek and his team, using a dividend discount model or, discounted cash flow, they go out and look at private equity transactions. Like, what did you buy? Okay, if O'Reilly Auto Parts got taken private, like, what was that multiple at? So live transactions, either public buying public or private buying public. So they typically see 5 to 6 names per year being taken out of their portfolio at a premium. It's great because that's a constant justification of their process and like valid inputs, right? It's like, I need to sell my house today, and if my neighbor who has a similar house, because it's a planned development, just sold it, like, that's a live input. It's not a random comp from another neighborhood down the street. Private equity is slowed, just given the degree of uncertainty. So, that pace has slowed for them a little bit, but they're always going to be kind of 2 to 3% cash.
Thank you. Any other questions?
Brian, can you go over page 6? Just let's review where we are against our policy.
Yep. So page 6. So green triangle, as you look across each of the individual asset classes. So every asset class has a target allocation. That's the black vertical bar you see inside of each of the gray rectangles. The green triangle represents current exposure. And the gray triangle from left to right encapsulates visually the minimum allocation and maximum allocation. So this is all derived from the investment policy statement. And recall, the minimums and maximums are essentially there to say you can't fall too in love with an asset class. If it does well, you got to trim it back. And you can't fall too far out of love with an asset class. If it gets whacked in the markets, you have to rebalance back into it. As long as everything is green, we know that we're in compliance with the investment policy statement. So we are right now slightly overweight U.S. large cap and slightly overweight international equity. That international equity overweight is just because of the success in the first quarter of international versus U.S. But generally speaking, the overweight we have to domestic equity is because we're underweight alternatives. So like as Michael had mentioned, we have a $5 million commitment to Capital Dynamics. $3 million of that hasn't yet been put to work. Well, if you said no to private equity or alternatives, that 5% has to be invested somewhere else in the portfolio. That would likely be in equities. So while we have an unfunded commitment, we're not just going to park that in cash and say, hey, it's going to take you 2 years to put this money to work, but we'll just have it in cash here just in case you make a call. It's invested in other parts of the portfolio. So the overweight to domestic equity isn't a call on going to be overweight. It's, well, if we're 2% underweight in alternatives, we're going to be 2% overweight somewhere else because the money needs to be invested.
Right. So, bottom line, we are in compliance with our investment policy. And we reviewed that policy at our January annual meeting. And don't think that we need to revisit that or make any changes at this time.
Okay. Thank you, Michael. Next thing up is the custodian RFP.
Yes, so, excuse me. At our last meeting, I addressed the committee and said that, and does everyone have a copy of the custodian review? Okay, I brought copies also. Okay. So I issued an RFP for our custodial banking services. The intention was to consolidate our banking services. Right now we have Fifth Third Bank is our custodian for the defined benefit pension plan and for the retiree healthcare trust. And I also wanted to consolidate our township operating reserves, which are currently held at 2 broker dealers. So I wanted to get a, one-stop shop for all of that, and also to make sure that we're getting the best possible price, the best possible service. So we issued the RFP. We got 4 responses, as you see here, from Fifth Third Bank, Comerica Bank, U.S. Bank, and PNC Bank. All, big regional players. Of course, we're too small to get the attention of the Bank of America's, JP Morgan's, et cetera. Comerica Bank is just way out of the price stadium. And so Fifth Third is our current custodian. So Brian and I had a call with both U.S. Bank and PNC Bank, and We did a demo of their online platform for managing the accounts, talked through how that would work. They were both very good and certainly, I think, would be a big step up from where we're currently at. Our process right now is very manual and human intensive, which is prone to both error and security risk. But the U.S. Bank and PNC Bank system is all self-contained and secure and eliminates a lot of that manual entry. So in the end, my recommendation, and I'm looking for consensus from the committee, is to move forward with U.S. Bank. They are the lowest costs, and I felt that their platform, their online platform was better than PNC's, and felt pretty good with their team that we talked to. So happy to entertain any questions.
Only because you put it in red, you know, the 2% recovery fee, which is very small because these class action suits are minimal to begin with. I mean, why the difference? Did we ask that? Because it's like nobody else has that.
If it's in, yeah, so I denoted in red if it was a piece of like differentiation.
Sure.
Because others, you know, it's included or
Right.
whatnot.
Well, and the revenue sharing, what's the difference?
So again, just red versus, I just asked that question because sometimes you can purchase mutual funds, a given share class that would have revenue sharing embedded into it. And that revenue sharing is paid to the financial institution that holds the fund. We go out of our way with every fund that we purchase to make sure that it's as stripped down and as cost effective as possible. There's nothing in your portfolio that pays revenue sharing, but it's something that we want to be aware of. Oftentimes what you see is you'll have somebody come in and give you a super, super low bid. And it's because like, okay, this is the explicit money we're going to make from you, but we're going to make a bunch of money over here that you can't really see, that we can't really quantify, but is meaningful to us. And we've seen that in the past with this revenue sharing aspect. But from an industry standpoint, you're seeing, and it's really a push from financial advisors and institutional consultants of like, you can offer a variety of share classes, but you better give me one that's just your management fee and whatever it costs to administer the fund. Eliminate all the other noise. So from a fiduciary standpoint, I can make the lowest cost recommendation to the client. So it's there as a point of different, it's red because it's different than the others, not because it's a concern.
Right. Thank you.
And the other, I would say, unquantifiable, like I can't calculate it, but I will tell you it is infinitely valuable to the township, is what Michael had mentioned, is if we need to do a trade, if we need to wire money, if we need to move money between accounts, rather than having a physical letter being scanned and emailed back and forth between institutions, all of this is done inside of the bank's secure website. So there's nothing being transmitted with account numbers and routing numbers over email. I hope there's never an instance where this is a concern, but we've seen an uptick in fraud everywhere. So unquantifiable, can't calculate it, but an invaluable benefit to each of these portfolios from a security standpoint.
Okay. Thank you. Do we need a vote on this?
It's an advisory committee. I don't know. Do we need a vote? Do we normally vote on this kind of stuff?
No. Okay.
No?
Don't need a
Okay.
consent. Okay. Thank you for that. And then number 7, new investments. Any new investments to discuss at this time?
No, Brian talked about ABS, which was our new emerging markets thing. The only other open item, I guess, would be we have some available allocation to alternatives. And Brian and his team have been vetting some new private equity firms that they, so at this time, I guess you don't have a recommendation, but
Not there yet.
yeah, so, but maybe at our June meeting, we'll have a recommendation for another investment in private equity. We did look at one hedge fund. Dave, you and I talked about that fund on Nantucket, and decided that it was not a good fit for the portfolio, so we didn't move forward with that. But,
We also interviewed an international equity strategy that just didn't feel confident that it was the best fit for the portfolio. So continuing to look at options, but being patient and making sure that it's the best opportunity and best fit.
Anything else before I adjourn the meeting? I get a motion to adjourn.
So moved.
Second?
Second.
move, second.
Second, okay, thank you. Meeting's adjourned at, I can't see, it's too far away.
8:35.
8:35.